Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm happy to have Ryan Keefe, also a certified financial planner with our firm, to be joining us. Thank you for joining us today,
Thanks for
Ryan.
having me.
So this is the third part of a series where if you watched the first two, great. If you didn't, well, guess what? I'm telling you what happened. So we've had a tremendous amount of viewership and comments, and it's obviously measurable on the internet somehow, some way. I don't measure it, but we've done this a couple times before, maybe just once. We did a question and answer. Okay, well, what we did this time is like, hey, it was back by popular demand, if you will, is we really went through artificial intelligence, chat GBT or something like that, whatever we did. Produced a list of 50 questions, organized them, and said, hey, these are great questions that people ask us. So made it nice and easy that they're produced. So the first episode, we talked about general overall financial planning, building a financial plan, what do you do, et cetera, et cetera. In the second episode, then we got into the retirement planning, which isn't in the same order of the 6 areas of financial planning, but based on our discussions of the financial planning, it led itself nicely into retirement planning. The next area is really it's cash management, which is the first area of financial planning. However, what we're doing is focusing on debt management. And quite frankly, whenever we talk about cash management, we always say foundation of the financial plan is get control of your debt, because that is the most efficient way of improving your overall financial plan and your balance sheet. So you ready to get started?
Let's do it.
All right, perfect. All right, so the first question that was asked is, how do I prioritize paying off multiple debts? It's actually a good question, and I'm just looking ahead and seeing the second question, and they go hand in hand. Do you want to take this one?
Yeah, sure. So whenever I, come face to face with a client who's got multiple debts, the first thing we want to do is get organized. Get all those debts listed down. And generally, I like to run them by what's the total balance, what's the interest rate of each loan, what's the minimum payment, and what's the term of each loan. Generally speaking, that's going to give you a nice foundation where you can look and see, okay, this interest rate is significantly higher than this interest rate, and this balance is significantly more than this balance, and you can decide, a plan of attack from there. And that kind of leads us into our next question.
Yeah, and so again, going with that is, you got the mortgage. It's a giant one. It's going to be 30 years. You want to try to overpay your mortgage? Guess what? You're going nowhere. Because here's what's important about almost all debts is if you overpay your mortgage, which is $2,000, and I decide that I am going to pay $4,000 this month, how much is my next month payment? $2,000. Okay, so in other words, I didn't help myself other than on the back end because I reduced my balance. It's a simple loan, but remember, you make an extra payment, it's not helping you, okay, from the perspective of reducing your payment next month. But the next question, which the first question led into it, is what is the debt snowball method versus the debt avalanche method? And this is kind of interesting because I'm hired by this company called LendEDU, and LendEDU sends me about 3 articles a month that I do an expert review as a CFP. I just got this one last month. So tell you what, I'll let you take it.
Sure. So you got two, debt payment methods, one being the debt snowball. Debt snowball, you start with, once you list out all of your debts, you take a look at what's the smallest minimum payment or the smallest debt that you have. And basically, you got to make all the minimum payments on your debts. Otherwise, it can impact things like credit score and a bunch of other stuff. But when it comes to the debt snowball, you want to take a look at that smallest debt, and whatever amount you can afford to overpay that debt, you're going to overpay that every month until it's paid off. And then once that debt is off your book, so to speak, you take that payment and you apply it to the next smallest, and so on and so forth until they're all paid off.
Right. And so basically what happens is that if you have $1,000 a month and you got a few big whoppers in there, the 400 to 300 to 200 and 100, by you paying off the 100 quickly and getting it out of the way, That means your minimum payment goes away. And to what I talked about earlier, if I just pay a little extra to all four of them, guess what? My minimum payment is still the same next month. But if you plow through the lowest one, it gets it off the books so that it reduces your minimum payment the following month.
And then you take a look at the Avalanche method, which basically just takes a look at the interest rates. And it takes a look at what's the highest interest rate I have, and that's the debt that you're going to pay off first. And it might take a little longer for you to chip away at that debt because it's growing so rapidly. But once that's paid off, think of an avalanche. It kind of it cuts all the other debts down in a much shorter time frame than the snowball, which as imagine pushing a snowball, it's just growing and growing, but you're not really making a ton of headway until the very end.
So the irony of it is that until I did that article about a month or two ago, and I think those articles are on the website, I never knew those names existed. I was like, holy smokes. So ironically, I've done it myself. Okay. And I am not a proponent of one versus the other. I am a proponent of looking at it and figuring out of the two methods, which one is better. Because I actually did that, was it 1995? I had a significant amount of debt across 6 different credit cards. And the credit card interest rates ranged from 6% to like 18 or 20%. And, the immediate knee-jerk reaction is, get rid of the 20% one, but it happened to be the big one. And the reality of it is that I knew getting rid of that 20% one was going to be a daunting task because it happened to be the biggest one. But I had one in there that was 17%, but was much smaller.
Yeah.
So what I did is I said, all right. And then I had ones that were lower that were smaller yet. But I said, no. I'm going after that 17. So it was a little bit of an art or a science. I'm not sure which one it was, but it's just good to go in with a plan and, do something that makes the most sense to be able to accomplish the goal of getting the debt off the books. Because, there's good debt and there's bad debt. Most debt is bad, but there's some debt that's less bad, like a mortgage.
And one thing that you've shown me and we've presented it to clients is if you're kind of a numbers guy like we are, plot your debts on an Excel sheet and then graph them. And you'll see the balances start to go down. And it kind of creates a psychological effect of, number one, you don't want to add to it and see the graph go back up, but it'll also make you motivated to pay off that debt a little bit quicker.
He's speaking from my experience from back in 1995 when I was doing that. Because what I was doing is exactly that. Is every month I would tag exactly how much my debt was. And as I was paying them off, I had this little system that then I'd start a new month and then I plotted it. And, I get a bonus and then it goes right to the credit cards, So my plan was that I was a very aggressive plan to pay it off in 5 years, and I got it done in 3. And I was very pleased with myself because what ended up happening is because I became obsessed by it. And part of the obsession was the graph. It was cool watching it go down. It was a beautiful thing. Then if you pay a chunk off because you get a bonus, and it goes down, and then you're paying off and so when you have the snowball method, what it's doing is it's freeing up more money that you can drive to one of the higher interest rate cards. And so I was using a combination of the two methods, not knowing that there was names to the methods. All right. Anyway, we beat that horse to death. All right. So next one is, what's the best way to manage credit card debt? I like that one. I don't know where that belonged, but what is the best way? Don't get in it.
Yeah, pay off your credit cards each month.
Right.
With credit card interest these days, you're paying outrageous interest rates for this unsecured debt that you have. And it tends to just get out of hand. A lot of ways that I like to, kind of manage it if you have credit card debt that you can't pay off each month. Automate your payments. And I always recommend that you try to make more than the minimum payment, because if you make the minimum payment, you'll see this on the back of your credit card statements. It'll tell you how long, if you make the minimum payment each month, it's going to take you to pay off the credit card. And a lot of people get a little scared.
Yeah, it's like 13 to 17 years.
Yeah, it's a crazy time frame. But if you just make 50, 100 extra dollars a payment, that dramatically decreases to maybe 2 to 4 years.
Well, so what's also interesting is a lot of people don't understand how credit cards work. Okay, if let's just say that the credit card period is from the 1st to the 31st. You get your bill and it's due on the 28th of the following month. So what happens is if I start the month with having paid off my credit card balance, then what happens is all of my charges during the month do not accrue interest as long as I pay off the credit card at the end of the following month. If I had a $1,000 credit card bill and I paid $950, they go back to all of my charges and I am paying a daily interest rate on the daily balance, even though I paid most of it off. Then if I didn't pay the whole thing off, then guess what? Because I start the new month with a $50 carryover balance, every time I charge something, it is immediately accruing interest that day. So for people who are in the process of assessing their credit card debt and have an approach of paying it off, what I suggest that they do is they carve out a separate credit card that they actually are using, gas. I mean, that's one of the most convenient uses of credit card is to pay for gas. You pull up to the pump, use your credit card. Use the credit card that you are using for your daily expenses, and you use a card that is not, that you're paying off each month, because when you're making these charges every day throughout the course of the month, you're not paying interest. And then every month when you have extra, you're plowing it, whether it's a Snowball, Avalanche, or some combination method, then you're at least taking the excess and plowing it to those guys. But you make sure that you have that one card that you're paying off every month. That's the card you use.
And just to piggyback off that a little bit, if you have excessive debt and you're really trying to pay it off, but the interest rate's just killing you, you're paying like 20, 25%. I've even seen 30 sometimes. What I've recommended to people is use balance transfers.
Yes.
Where you take the balance of one credit card, you open up a new one, and it transfers the balance over. And usually there's a promotional period of, it could be 6 months, could be a year, could be longer, where you're paying 0% interest. And you pay a fee to do so. Generally, I've seen 3 to 5% of the balance. But, a lot of times that what you're paying is insignificant compared to the interest that balance is accruing. And at least it gives you some time to kind of get your ducks in a row and pay down the debt while it's not earning.
Absolutely.
Basically.
So let's take it. Great example. Okay. I mean, I referred to it as a credit card shuffle. Okay. And that was when what I did back in 95, I said, all right, I'm tired of this. Okay. And that's when I pulled it all together. And this is what we were discussing in prior episodes in the first one. Organize your finances, the very first thing you can do. And so I pulled it all together and actually felt better. Once I knew how much it was, trust me, I didn't feel better, but I felt better simply because I finally organized it. I finally said, I am grabbing this bull by the horns. And so when I did that, I forgot where I was going with that.
Credit card shuffle.
Yeah, the credit card shuffle. So take, for instance, you have the 30% credit card, and let's say it's a $10,000 credit card debt. What happens is basically you're paying 30% of 10 grand, which is $3,000 at the end of the year. As opposed to doing a credit card transfer, what you're doing is you're going to pay 5%. Usually it's 5. I've seen as low as 3. It's getting more to the 4 and 5. But even if I'm paying 5% and it's 0% for 1 year, I paid 5%, which is $500 instead of 3 grand. And at the end of the year, as I'm making payments, what's going to happen is the balance goes down, and then if it goes back to 30%, it's 30% on a lower balance. It is a good idea. if you are managing it properly, if you're grabbing the bull by the horns and you're doing it, it's a way of improving the amount of money, because that difference of $2,500 that was going to that 25% or 30% credit card can be extra plowed towards the principal on that card or other high interest rate cards. That is a great idea. Absolutely a great idea. All right, so what do we got next? How do I improve my credit score quickly? I'll tell you what, we're at a good breaking point right here. We're going to pick up that question on the second segment. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're picking up on the debt management. I goofed at the end of the first segment as I jumped ahead because I missed a question. The question was, should I be investing or focusing on paying off debt? Great question, and that is an easy answer. Okay, it depends. But the reality of it is this, is it depends a lot upon the interest rate of the debt. So if I had a debt that was costing me 8%, instead of paying off that debt, let's say it's $10,000, it makes the math easy, okay? Instead of paying off that debt, I invest 10 grand. Well, what's the problem with that? If I invest the 10 grand, I'm going to be paying taxes on the interest of the growth. And so if I'm paying taxes at 15 or 20%, let's say it's 20%, I have to earn 10% to get the 8% that I otherwise would get by paying off my debt. I can't think of a guaranteed investment that's going to provide 10%. And if you know one, please let us know. I mean, so rule of thumb, I always say, it is not a good idea to borrow to invest. And that's actually, there was another question. In fact, I think, where is it?
I think it's at the very end.
Is it ever a good idea to use debt to invest? So let's piggyback to that question. And the answer to that is the same reason is, should I invest or pay off my debt? The reality of the situation is, unless you can get a guaranteed rate of return net of taxes, because that 8% that I'm paying, I'm not getting a tax break.
Mm-hmm.
Okay. Now, I will have you know, and I hope that compliance doesn't rip me a new one for this one. There was one time that I did it. Okay. Now, mind you, it's unique. All right. And I did it. And the problem is compliance snagged me in an email because I told the client to do it. And here is the example that I did it. Is I had a client receiving a $20,000 bonus around January 15th. Okay. And he wanted to contribute. Actually, it was more than 20. It was a giant number. It was like $50,000 or $100,000. It was a giant bonus. And he wanted to contribute to 529 plans. But you can get a tax deduction for contributing up to, at the time it was 15 grand. You can get a tax deduction. So I said, look, you're getting your money on January 15th. I said, but if you contributed $15,000 to the 529 plan in December, you get a write-off.
Right.
And that write-off effectively created a 3%. It created a $450 tax break, literally tax, because he gets 3% of 15,000. And if you looked at, he borrowed it from his line of credit, and we did it at the very end of the year. It cost him probably, I think it was like $10 in interest. Mm-hmm. Okay. I said, that is the one example of which I got smoked by compliance. You can't do that.
Yeah.
And you know what? I turned around and I said, guess what? I would do that every time. Yeah. But the answer is, generally speaking, you never want to borrow to invest. Okay. Because what you're doing is you're borrowing money. You're paying a finite rate, but you're investing the money, and you're not guaranteed on your investment, and you have to pay taxes on the investment.
Right.
All right, I had to get that one out of there. All right, so next question was, should I refinance my student loans or mortgage? Ryan, you want to take that?
Yeah, sure. So, I mean, when it ever comes to refinancing, what are really going to be the main drivers are what are the interest rates. So you got to look at what's your current rate you're paying and what are the market rates going for these days. Generally speaking, if they're lower than they currently are, it may be a good idea to look into refinancing. When it comes to looking at refinancing, a mortgage per se, one of the things that you're going to want to be very cognizant of are what are the closing costs. A lot of times those, it costs a certain amount of money to do the refinancing of the loan, which will be added on to the principal, and it could kind of negate the savings you would get on the lower interest rate. But when it comes to looking at student loans, what I really want to emphasize is do you have federal loans? Do you have private loans? If you're taking federal loans and you're refinancing them to private loans, you really want to be cognizant of what you might be losing if you do that. Things like loan forgiveness, income driven repayment programs, things of that nature. So you just want to be cognizant of what you're doing when it comes to the refinance.
Well, your loan forgiveness, particularly if a student dies and they have a federal loan, they don't have to pay it.
Right.
Or the various different programs that the government provides for federal government student loans, whether it's all the different programs they have for repayment programs and things along that nature, or deferment. There's a lot of things that the government loans provide that the private loans don't. Right. And, so you really have to weigh it out. Now, I did it. Okay. I did a refi twice in a very short period of time. What did I do? I refinanced from 3 7/8 to 2 7/8. I saved myself 1% on like $250,000 and no closing costs. Shocking. It was no closing costs. All right. Kid you not. So I'm like, well, that's a no-brainer, because if I have a $250,000 loan and I just went from 3 7/8 to 2 7/8, well, then guess what? I'm saving $2,500 a year in interest. A year later, I didn't go from 250 to 200, so I don't know what it was. A year later, I actually had to pay $1,000, and I took it from 2 7/8 down to 2 3/8. So it's like, wait a minute, that fee was $1,000 to do. This is how I remember it, because I had a $200,000 mortgage at the time. Mm-hmm. I said, well, look, it's costing me $1,000, but I'm saving 0.5% of 200,000. I'm saving $1,000 in 6 months. So I did it. So I have a 2 3/8% mortgage. I've only seen one person tie me. I caught the bottom. What are you gonna say? I caught the bottom. I also moved it from a 30-year loan to a 15-year loan because I was making that payment anyway.
Right.
So again, should I refinance my student loans or your mortgage? It depends on the interest rate that you got. Now, that said, those people who bought a house in the last few years, when interest rates ran up over 7%, it is possible that the interest rates come down. And if the interest rates come down to, say, 5 or 5.5, then it might really be worthwhile to refinance. But to your point, it's very important to understand the fees and the costs associated with refinancing and how soon will you recover that.
Right. Absolutely.
Okay. All right. Next question. How can I improve my credit score quickly? You can go ahead.
Well, so one of the main tools that I use personally is I use creditkarma.com. Mm-hmm. Very educational tool, free to use, and it basically outlines, what's impacting your credit score, both in a positive and negative manner. One of the things that I always tell clients before they do anything, look on Credit Karma to see what's impacting their score. You'd be surprised the amount of times that people go on and check their credit reports, and there's actually an error there, and that error is really impacting their score. So if you can, if you find one and you get it off there, that can dramatically impact your credit score in a favorable way. Always make on-time payments. If you don't want a serious drop in your score, you want to keep the average age of your debt or credit, relatively older. So you don't want to open up a bunch of new credit cards every time you're doing like a balance transfer, things like that.
Yeah, that hurts you.
That'll hurt you. So you want to keep those in mind. Another thing that I've seen happen to a lot of people is they use a significant portion, like over 50% of their credit limit. So one of the things you can do is go to your, credit card company. If you have a home equity line of credit, you can look at getting an increased limit, and that will, by having more of a limit, you'll lower the credit utilization ratio, and thereby that'll increase your credit scores.
Right, to his point. So, for instance, you had a $5,000 credit limit with $1,000 on your balance. Well, it's 20%. But if you raised your limit from 5,000 to 10,000 and you still have $1,000, it's 10%. And so, not to promote, and it is certainly not the intention of promoting it, but quite frankly, I had used Credit Karma for quite some time. In fact, almost everything I learned about credit was literally from tracking my credit score. To Ryan's point, I caught things on there that were inaccurate. Okay, one that hurt me and one that helped me. Ironically, one that helped me is a line of credit that I closed like 20 years ago, but it says, hey, I've had it for 30 years. And I've had it for 30 years and my credit age is like 12, 13 years. I'm like, that helps. But one thing that I did realize, and case in point, and I'll give you the anecdote to it, is that there are two thresholds, 30% credit utilization. So if I have a $10,000 credit limit and I cross over $3,000, which is 30%, then my credit score drops. But if you're below 30%, then it's good. You're below 10%, it's great. Anecdote for that. Every year, my company credit card gets thwacked in November because we have all of our licensing fees and we have an event that we do every year, late October, early November. All of a sudden, my business credit card gets thwacked in that particular month. And I kid you not, it drops my credit score by about 70 points. Okay, so it takes me from like an 800 down to 730. And then when I pay it off the next month, back to 800 again. So it's kind of funny to watch my chart back up again. But, it's important to understand because you run into this a lot of times when you're the junior of, like Ryan, you have a son named Ryan Jr., okay, and you'd be surprised how many times wires get crossed. In fact, we got a client, ironically, got divorced, and her ex-husband remarried, same name, okay? And so she's actually getting stuff in the mail from the new husband, the new wife of the ex-husband is showing up on her credit report. So the long and short of it is, understand your credit, know the impacts that are going into it, and you can raise your credit score very quickly by decreasing the amount that's on your credit card debt. Yeah. You can't increase age very quickly.
Right.
Okay, that just takes time. By the way, I crossed over average 9 years just like 2 months ago.
Hey.
So again, I like the Credit Karma because there are others. You can go to your other agencies, and that's the one I've used, and I found that it's very educational.
Right. Me too.
And we're all about education here. All right, where are we now? Oh, what's the difference between a secured and unsecured loan?
So one's secured, one's unsecured. Nah, just joking. But basically, a secured loan is something that it's collateralized. Therefore, you think of things like your mortgage, car loans, debt that is backed by an asset. So generally, the pros of those assets are, since there's something backing it that the bank can seize from you if you fail to make payments, they generally will offer you a lower interest rate, and they'll generally offer you more financing because there's an asset that has value to it that they can kind of sink their teeth into. The risk of those is that you could lose the asset if you fail to make the payments. You get foreclosed on your house, they seize your car, things like that. Unsecured loans, be things like a personal line of credit, credit cards. These are things that are not backed by any sort of asset. So generally, they're going to come with a much higher interest rate, and they generally will offer not as high of a credit limit or financing amount. That's why a lot of credit cards are, will have like a credit limit of, say, like anywhere 5 to 10 grand, depending on your finances. But the cons of those guys are you're going to get hit with much higher interest rates because there's nothing really backing them. The only thing that's going to hurt you if you don't make payments is they may come after you, personally, and your credit score is going to take.
Oh yeah, you get whacked with a credit score. Yeah, late payment. And late payment, by the way, is first of all, if you're 5 days late or 1 day late on your credit card, what's going to happen is you're going to get thwacked with all of the interest plus typically a $39 late fee. But it doesn't appear on your credit report unless you're at least 30 days late. And then 60 days late's even worse. And what's worse than 30 and 60? 90. Exactly. So once again, that's how you control your debt. So how do I know if I am carrying too much debt? I don't know if that's a great question or a lousy question, but you would know if you have too much debt. I mean, if you can't make the payments on your debt, then you got too much debt.
Yeah, I would say I run into people all the time that they don't even contribute to their company retirement plan because they need the money to make minimum payments on the debt. And that's my general rule of thumb. If you can't put money away for yourself, whether it be an emergency savings or contributing to your retirement plans, you have too much debt and you need to figure out a way to get that paid off.
So the other thing that I would like to say as we wrap up, it's not discussed in here in debt management, is what we've done plenty of times is we've had clients open up home equity line of credit. And, for instance, they may have, if you own your home and you have equity in your home, what it does is it basically gives you the ability to either take some of that money from your home, as Ryan pointed out, because of the fact that it is secured, you can get a lower interest rate. You may be able to get a home equity line of credit that's going to be at prime, which is about 7.75% or 7.5%. And you turn around and you take that and you pay off one of these 30% credit card debts. All right. That's one way of managing your debt. As long as, and I've seen this before and this really irritates me, is I've had people open up their home equity line of credit. They say, God, it's a wonderful thing. And they take $50,000 and pay off all their debt. Okay. And now their monthly payment is much lower. And then a year or 2 years later, all their debt is back again. Okay. And that's poor management. That is absolutely poor asset management and poor cash flow management. But the other thing that I've had people do is, when we had a situation like this, someone had like a whole lot of money in their savings account and they had some debt. And they said, well, look, why don't you open up a line? So why do you have all this money in your savings account? Well, in case of an emergency. I'm like, all right, let's think about all of the emergencies you've had in the last 5 years. Well, I haven't had any. I'm like, okay, great. That's fine. Okay. I'm glad that you have that emergency reserve, but your savings account is paying you 3%. This debt is costing you 15 or 10. I said, look, why don't we do this? Why don't we open up your home equity line of credit, use it as your emergency reserve. Whereas if you have an emergency, a true emergency, then you can go into your line of credit. Meanwhile, what you do is you take a bunch of your cash and pay off your debt. Okay, and what ends up happening is all of a sudden your cash flow is improved dramatically. And then you turn around and say, all right, now it's time to take that savings and plow it into your 401k or plow it into some type of investment program. So, all right, we blew through our 30-minute limit.
There we go.
All right. So, but anyway, thank you, Ryan, for your assistance today. Thank you for joining. I hope you got an indication. We're not fans of debt. We're fans of paying down debt. You get rid of debt, and guess what? You're going to improve your financial situation. That's probably the first place you can go. So thank you for joining us, and we look forward to catching you next time. And the next time, we're going to be talking a little bit about insurance and risk management, followed up by investments and tax planning. So thank you for joining us. Have a wonderful day.